I'd like to introduce you all to the basis of the discussions that we're going to be having today. A housing finance company is another form of a non-banking financial company, which primarily is engaged in the business of providing financing for housing. With the growth of major HFCs in India providing housing loans to home buyers, the housing finance sector has experienced unprecedented growth from being a government-provided service to private players entering the housing finance market to provide such services. The provisions for the regulation of HFCs are provided under the National Housing Bank Act 1987, with the National Housing Bank being the regulatory authority for HFCs. In order to avoid dual regulation, certain exemptions were granted to HFCs from the provisions of Chapter 3B, provisions related to non-banking institutions receiving deposits and financial institutions of the Reserve Bank of India Act 1934, by notification dated 18 June 1997. In 2019, the NHB Act was amended and certain powers for regulation of HFCs were conferred with the Reserve Bank of India pursuant to such amendments. Revised regulatory framework for HFCs. On 22nd October 2020, the RBI issued the revised regulatory framework for HFCs. Definition of HFC. Under the revised framework, an HFC has been defined to mean a non-banking financial company engaged in the housing finance business and which fulfills the following conditions. Under its financial assets in the business of providing finance for housing constitute not less than 60% of its total assets, and out of the total assets net off by intangible assets, not less than 50% should be by way of housing finance for individuals. Transition time for existing HFCs to fulfill the asset-based criteria. The revised framework has allowed a transition time to 31st March 2024 to the existing registered HFCs to fulfill the asset-based criteria as set out above in case such HFCs propose to continue the business as HFCs. Pursuant to the announcement made in the Statement of Developmental and Regulatory Policies dated December 4, 2020, a discussion paper titled Revised Regulatory Framework for NBFCs, a Scale-Based Approach, was issued for public comments on January 22, 2021. Based on the inputs received, it has now been decided to put in place a revised regulatory framework for NBFCs. As the SBR framework encompasses different facets of regulation of NBFCs, covering capital requirements, governance standards, prudential regulation, etc., it has been decided to first issue an integrated regulatory framework for NBFCs under SBR, providing a holistic view of the SBR structure, set of fresh regulations being introduced and respective timelines. Detailed guidelines in the annexure will subsequently issue. Thank you. Now we would be putting across questions to our esteemed panelists, starting with the first question. What are the key challenges faced by housing finance companies amidst COVID-19? I would request Mr. Banerjee to share his views on the said subject with us.
So, thank you, Sumesh, for having me over at the outset. Very frankly, initially the way COVID had panned out, with the immediate standstill that happened across, where there was a grinding halt and it happened without any intimation of sorts. So as we all know, everybody got impacted. Of course, there was a lot of support from the financial regulators. There was, at an immediate basis, institutional growth was a challenge. There was a huge pressure on the quality of the assets. But subsequent to the entire support, which was lent on account of the various circulars issued by RBI from time to time, the entire thing on moratorium, the ECLGS, etc., I think by the time the first closure happened and the second round happened, I think largely institutions were fine. In fact, for HDFC, we did some record numbers. The March closing on both the occasions were tremendous for us. There were, of course, a lot of intervention. Like I remember Maharashtra had given specific exemptions on stamp duty and registration fee. So as far as our sector was concerned, there was a lot of enthusiasm, because on an actual basis, the end user was saving out a lot of money by closing a transaction during that 31st March. So while initially there did seem to be a lot of concern around growth, quality, our own liquidity, I mean, one was not very certain because money was on a different trajectory, it seemed. And of course, corresponding pressure on profitability. But the fact is that by the time we were coming out, we realized that it possibly actually was one of the best times that we have done business in. For HDFC, I can tell you we did record numbers. The last 2 years, Bombay, Delhi, these two regions were fantastic. And this year, as I don't know if you're aware or not, but we, of course, the little pressure that we saw on the retail side on our NPA, we've traditionally been a very, very fine number. We've maintained a very, very fine number. So that was back this year. It was again in control, and I'm very happy that we could do that. So yes, there was a concern, but thankfully, strong institutions which had good business ethics and governance standards, I think most of them were able to sail through and tide through. Right. So, yeah.
Absolutely. I would request Mr. Khan to share his views with us on the said subject.
Yeah, I think the key challenge that everybody faced, I think, was largely on the asset quality, because the entire lockdown, there were enough people whose livelihood was impacted. So I think the post-COVID, one of the biggest challenge everybody faced was on the asset quality side, and that coupled with the entire lockdown piece and other stuff actually slowed down the entire credit growth perspective. But I think that entire piece was over by September 2021. And post that, we have seen, both on the asset quality side and on the growth side, the things have started back. But in November, we saw, another set of change coming in from RBI in terms of the change of the NPA norms, and saw another set of disturbance. So I think all that put together, the industry took it in its stride, and now all those things are behind us. The credit growth, at least in the Q4 of last year, as we saw, it has returned. The asset quality continues to improve. There are still some challenges on the liquidity now, and with the increased norms on the entire NPA classification, some bit of profitability pressure we'll see for next couple of quarters. But other than that, now I think we are back on track.
Absolutely. I would request Mr. Saxena to give his views on this topic.
Yeah, yes, all the aspects, 4 aspects have been listed: credit growth, liquidity, asset quality, and profitability. They're all impacted by the COVID. It was a total shutdown for about more than 24 months. Nearly 12 months complete shutdown, and then the partial shutdown, and both the supply side and demand side factors were affected. Supply side means, and even the money supply was also impacted, and the companies have gone into the liquidity problems. So on the supply side, because it was shut down, so under construction projects are the people were not available. So for the total shutdown, I mean to say, and it has impacted asset quality, yes. But to meet these challenges of asset quality, certain concessions RBI has announced regarding the moratorium, and the assets which have gone into moratorium is not to be considered under the NPA classification, provided they were standard on certain benchmark date. So these measures were adopted. On the liquidity side, yes, RBI has provided the liquidity support through NHB refinance window. So the short-term refinance was provided. I don't have any idea about the total HFC side, how much the measures have been used by the company, how much cases of moratorium you have gone through and got through that. and how much liquidity support you have got under these measures. Yes, profitability also got impacted. Credit growth, yes, credit growth was nearly half. It has impacted it. Even the today also it has not come to the pre-COVID level. Now other conditions are prevailing upon after the COVID, the geopolitical situations and others. Inflation factors impacting the credit rates are going up. So yes, I agree that other aspects were impacted. I'd be happy to share my views on any questions because I think that this is an opportunity to discuss across the board without going into the nitty-gritty that we all know. We can consult the papers, but at this stage, be happy to share with you from your side and from this side the views across. Next.
Yeah. Now, I request Mr. Nair to share his views on this subject with us.
You're on mute.
Just trying to figure out where the unmute button was. I hope I'm audible now.
Yes.
Well, Tanya, I guess the distinguished panelists before me have already anchored the views on all the four areas. I just like to add one major input when it comes to liquidity, and I guess that's a very key thing which happened during the pandemic phase. Both in terms of the regulators as well as the government, there was a huge push in terms of providing adequate liquidity to the system. This liquidity was available across the board, not just for the large NBFIs or the HFCs, but also to the mid-size and the small-size HFCs as well. This additional push on liquidity ensured that all the above issues, whether it be through an asset quality or asset quality induced credit cost, or for that matter profitability, was more or less kind of adjusted with that. So many companies or many HFCs took the benefit of having that additional liquidity, which was provided at an ease. I guess that was a bigger thing, because whenever any macroeconomic disruption happens, like for example, a major event like COVID, one of the things which goes out of the market is the liquidity. But the liquidity supply was ensured by the regulators and the government, which ensured that the pressure on the HFCs was lesser. They could focus on asset resolution and thereby improve their credit cost and also look at a decent amount of profitability. Well, this is something which is in the past. I guess many things have happened post that, and I guess we're going to discuss on that in terms of the regulatory framework, the evolving regulatory framework, how it is going to impact. I guess that would be a very, very interesting space to hear views across the board.
Thank you, sir. Now I request Mr. Sumesh Dewan to share his views with us on this topic.
Yeah. So again, coming to the challenges, so we as a law firm, more from a legal and a regulatory angle, we saw two major issues. One was obviously the big liquidity crunch, because there was a moratorium on payments, and housing finance companies and NBFCs were not finding it very easy to raise money. And then, being there a moratorium and challenges in terms of even during COVID and post-COVID, the defaults increased substantially. And typically, one of the key issues we always been saying is, although we have a SARFAESI law and a provision in place where technically our HFC can go and attach, but typically in most of the cases, the borrowers are able to seek injunctions or seek some reliefs, stalling the process. So that becomes a major hindrance, because the two sides. One, the HFC is facing a liquidity crunch and not being able to raise enough money, and two, the defaulters. Typically, although there's been a substantial, as Anika rightly said, most of the larger banks and HFCs have done some great business in the last 2 years, but also there's been at least we see from a legal perspective, a increase in the default rate, and the recoveries of these also becoming a bigger challenge.
Thank you, sir. So the next question I'd like to put up to our esteemed panelists is that what is scale-based regulation? And what's the thinking behind this new regulatory and supervisory approach, in your opinions? So I'd like to ask Mr. Banerjee to share his opinions on this with us.
So this skill-based regulation thing was something which was in the offing for some time. Uh, I think gradually we had seen that the sector required maybe a granular assessment, understanding. Per se, this entire set of NBFCs had grown from what was possibly originally conceived. We had a variety of NBFCs initially, and they were all brought into and then grouped together. I think the way some of these NBFCs impacted all of us required some reshuffling, rejuggling, so to say, and to understand that how risks are to be assessed, and also the impact of such risks should be as quarantined as possible. I thought with that concept, this whole regulation was brought out, in terms of which wherever a risk could be quarantined in a packet which would not have an impact on the other players in the market, they were kind of kept in a smaller bracket, which I think is identified as a base layer. And then there were certain people who had access to, say, public money or were dealing with consumers. They were identified as a middle risk with the ability of the regulator to peg them at a higher level of supervision, should there be a need. This is bereft of the fact that the top 10 of the category would not automatically be categorized as an upper layer. But the ability of the regulator to pick and choose and to get the affairs of a particular entity conducted in a regulated manner under the supervision was possibly something which I should have seen coming. The industry was impacted, and severely so, with some cases which we are all familiar with, and I don't need to take names, but the fact is that that had a cascading and a rippling effect, where I think all the courts were also, the regulators were also trying to figure out solutions. One of them is rather landmark, the way we have done a juxtaposition of both Companies Act as well as the IBC, brought it together and trying to find solutions. So before this reaches the courts, possibly it is important and pertinent that there's a regulatory intervention, and there is a characterization and assessment depending upon the enterprise, the size of the enterprise, the interaction that the enterprise does with the other parts of the industry, how the risks are interconnected. Today we are no longer alien. You know, if something happens somewhere, like the war happening in Ukraine, it's impacting anyone and everyone elsewhere in the globe. But similarly, in a smaller scale, one NBFC impacted so many at so many levels, because each one was leveraged in some which way or the other with the other. So I think this was coming for some time, so that there's a risk and there's a containment of the risk, and it should not have a rippling and a cascading effect. I think that possibly would have been the thought process. Even if you see, I think you'd quoted the 17th February circular. Basically, the idea of RBI was that if you're doing something, then you do it in the particular form and manner, the whole 60-40 and the 50-50 categorization within. So that rationale is there. This possibly just specifies and elaborates that whole rationale a little bit further, categorizes enterprises in the risk that they should be capable of handling. And wherever they are not capable of handling, then there is a supervisory intervention. So I think that is my understanding of the background of this circular, which is why there is a base layer, there's a middle layer, there's an upper layer and a top layer, should there be a need to categorize somebody as such. In fact, it's a global phenomenon. I think globally there's one case where I remember that global banks were also categorized in terms of where they are. So over to you.
Absolutely. Thank you, sir. I request Mr. Khan to share his views with us on this topic.
I think this was a move, as Andrew said, it was for some time, it was there in making. And I think with some of the incidents which happened with some of the large companies, I think it was very much required that government comes up with a regulation which divides or which puts a calibrated approach to the entire the regulatory and supervisory framework. And that is precisely what they have done. So they decided based on the size of the NBFC and based on the kind of market participation they have in terms of the way they raise money, because there are a lot of NBFCs who are deposit taking. There are some who are non-deposit taking. Some we are operating at a very, very small level. So they cut it down to 4 layers, and each of these layers typically the base assumption they have taken is that it's the size of the NBFC, and beyond that, the kind of risk they pose in terms of where they raise money and how they raise money. I think they have put it into 4 layers, and I think it would put a very different kind of supervisory compliance requirement now on each of these layers, which simplifies the task of identifying who are the ones who are systematically important NBFCs and who are not systematically important, and you can put a different kind of supervisory compliance on each one of them. So I think it's a fair thing to do, and now it has already come into place. People have started complying with it. As we move forward, I think we'll see a different level of compliance being defined for each of these layers, and my sense is that it will only make the entire industry more robust.
Absolutely. I request Mr. Saxena to please give his views on this section to us.
Yeah. As the discussion goes by, the scale-based regulation, the idea has come from the December 2020 monetary policy review meeting. After that, there is sustainability and developmental report of the RBI, where they have realized, the NBFC sector is going in parallel, in par with the banking sector also regarding the credit intermediation. So yes, I agree. There was a big and small companies, their market participation is larger, and there are interconnectedness in the financial sector with the companies. So it was realized that basis on the activity size of the operations and the interconnected with the rest of the financial sector, the companies, NBFCs, entire NBFCs, not only the housing finance, to be put under a calibrated approach of regulation. So earlier there was no scale based. If you look at the HFC side, I was sitting in an HB, and I used to call my people, why are you putting so much of seeking so much of information from a smaller company which is not even 20 crores capital? And the load of regulation was such high, compliance burden was very high for those companies which are not even just started 2 years back operations. So that was my concern, but there was no solution to that. All the returns have to come, and then now the thought has come that all the NBFC sector would be put under a scale-based regulations. Earlier, there were NBFCs, systemic important or non-systemic, deposit taking, non-deposit taking, and they were put under. So now it is only the 3 layers which is coming to play: base layer, middle layer, and the upper layer. In the base layer, the NBFCs which are non-deposit taking and asset size of 1,000 crores and less, they all will coming under the base layer, and these set of companies would be put under a lower level of compliance and the regulatory supervision. Now the second layer is the middle layer and the upper layer. So all the housing finance companies, they are coming to fall into the middle layer and the upper layer. Upper layer companies layer would be occupied by, yes, as Mr. Amindya said, 10 top companies. NBFCs will be definitely under the upper layer. Besides that, there will be 50 companies. Excluding those 10 companies, there will be another set of companies who will be put under the upper layer. They will be coming across more stringent measures of regulations. They will be asked for certain information. They will be put under like a bank, like as the regulation goes for the commercial banks. This is the same set of, similarly same set of regulations would go for them. Basel 3 will come into play for those set of companies. How they are going to be placed upper layer? There is a very scientific system RBI has provided. There's a matrix, risk-based matrix, and it is a weights are given, and based on that, the companies drop those matrix. And if you are falling into that criteria, those companies will be put under the upper layer. So the companies which are not falling into that,
Sumesh, you guys have gone on mute.
Yeah, that's right.
the start date of this effective date is from October 2022, but there is a good period of time has been provided. And those companies which are going to fall in the upper layer, they have to do some preparatory work. They have to get the supervisory regulatory policy approved by their board. There is a time frame that of 24 months. It has been provided. Within that, they have to get the policy approved and get this new supervisory framework put into place. So for the rest of the companies which are not in upper layer will be falling into the middle layer. So what are the changes that are coming into place because of this new regulatory framework? Yes, there's a prudential changes are there. On then the governance matters are also coming into picture. So that will come into when the two other part of the discussions, I think. So if you have any doubts about it, or you want to add, you want me to add on certain things, you can definitely ask.
So continue with the discussion, like what prompted, because as rightly said by everyone, it was long overdue where a new set of regulations was required, and typically with the introduction of these scale-based layers of NBFC, the RBI is typically doing away with the earlier classification of NBFCs solely on the basis of their asset size. And now, in fact, one of the key proposals being changing the minimum capitalization norms for specific NBFCs. For example, where RBI is increasing the minimum net owned fund requirement for NBFC ICC from 2 crores to 10 crores, and for NBFC MFI, and has been increased from 5 CR to 2 crores, and also the minimum requirement for any NBFC, even if it has not having any public dealing, to 2 crores, is a pretty welcome step, because it ensures that we are moving to a framework where we'll have very legitimate and companies, so which will see lesser defaults in the sector, and we'll have lesser challenges.
Actually, the idea is to have the company should have adequate capital to meet out their business plan as well as the liquidity constraints if they are going to be. And for the housing finance companies, there is no change in the capital structure. It's going to be minimum 20 crores. For the rest of the companies also, there is no change. Except for the smaller companies where they were on 2 crores or 5 crores capital requirement, they have to bring to the 10 crores capital by 2027.
Yes. So the next question that I'd like to put up to the panelists is, what are the various layers prescribed and how the HFCs are placed in the new framework? I request Mr. Banerjee to give us his opinions on this subject.
So I think Mr. Saxena has elaborated in detail about who's there in the base layer, middle layer, upper layer, and top layer. But from a perspective, I think the way the regulation is, the context is that wherever there is no access to public funds and wherever there is no interlinkage, that's what is in base. The moment you get any public enterprise like HFCs, these are the ones where they have categorized us in the middle layer, and the top layer being typically the top 10, as Sir has already identified, along with the that's the upper layer, and the top layer being what needs to be under strict supervision, where I think the authority sees a reason to categorize specifically. That is what the topmost layer is. And of course, there's a requirement that once you're tagged as a top layer, you need to be in the top layer until some time before one comes out of that. So that's typically, as I think Sir has very nicely elaborated, but what used to be deposit taking systemically important and non-deposit taking systemically not so important has been categorized and redone in a very different way. It's no longer the threshold of 500 crores. That threshold has gone to 1,000 crores, and of course the entire public dealing has kind of gotten input and a say in the categorization, and rightly so, because the moment something is intrinsic, that means there is that risk gets quarantined. It need not impact anyone else. But the moment there's an interaction with public, which is where a small depositor's money, your money, my money, is likely to get impacted, that is where the regulator has thought that yes, this requires a particular level of assessment, understanding, supervision, which is where we've already seen at least 5-6 circulars that have been issued since this circular came out. And of course, how large groups are expected to conduct, what is the kind of governance structure that needs to be there for middle layer and upper layer, of course, top layer. That's how the concept around which they have been. I think there is a category that needs to be possibly referred to in the circular: account aggregators, peer-to-peer platforms, lending platforms. They're just within themselves. They have no interaction with the world outside. So which is why they're possibly categorized at the lowest level, which does not require too much of supervision. But the moment there is an interaction, like say HFCs or anybody who is in excess of the 1,000 crore threshold, as we were discussing, that's where the regulator also says that yes, there's need to have a slightly higher level of regulation that needs to be made applicable, which is why we've seen a series of regulation that has come out on the sides since this original regulation came out. So that's my understanding.
I request Mr. Khan to give us his opinions on this question.
Yeah, I think Mr. Saxena and Anita both have explained, what these layers will look like. But I think from HFC's perspective, the important part is that there are no HFCs which are going to be in the lower layers. So whether it is base or they're not going to be anywhere. All HFC, irrespective of their size, are going to be at least in the middle layer. So I think that from HFC's perspective, that's an important point, because that would mean that there is going to be slightly higher amount of compliance that all HFCs will need to do, irrespective of the size they are. And I think some of these HFCs, if they are large enough, at some point of time they'll be transferred to either the upper layer, and as we all know that in case of there's anybody who becomes a cause of concern might get moved into top layer with a the stringent most level of compliance will be required.
Absolutely.
Yeah.
I request Mr. Nair to share his opinions with us on this.
Yeah, so I'll just want to take a step back first, and then understand that why this entire space has been created. This is all post 2017-18 period, when you saw large defaults happening, especially where these large NBFCs or pseudo NBFCs created a kind of a systemic issue. So given that background, again, these were a pretty much well thought, I would say, line in terms of how to regulate this large space, because correct me if I'm wrong, there are almost 10 to 11,000 NBFCs in this country, and how do you regulate them is again a big challenge, right? So again, it's been well thought, and to see to it that that such kind of instances don't happen, and the regulator only has to focus on a finite number where they can have a much better stronghold and understand the key challenges and issues and address the issues. Secondly, coming to HFCs, HFCs are blessed. Why? Because there is already NHB which has been working in this sector, and NHB over the years have been regulating and supervising this sector quite well, given the kind of nature of the ultimate objective to achieve. So over the years, whether it be through credit inspections or policy development or supervisory inspections, audit, HFCs have gone through all those things. So it is I would say that they're well prepared. there is not much to be done or to be prepared on that. And as the things unfold, like for example, November we saw the circular on the asset classification on IRAC norms. Similarly, now they're talking about taking that to a complete asset recognition point of view. And then now they have come across on disclosure norms on the financial statements moving forward, and there is a timeline for that. There is a requirement to appoint a compliance officer or a chief compliance officer, so to address the governance issue. So everything falls in place in terms of addressing. And as I said in the earlier part of the discussion as well, it is going to be a very, very interesting space to be. As far as I'm concerned for HFCs, thanks to this, oversight of NHB, more or less the sector seems to be on track, and we are all geared up to handle this. And as we progress, as my colleague Shakil said, many of us would eventually graduate to a top layer, and ultimately, follow the objective of providing an affordable housing to the country.
Absolutely. I would request Mr. Saxena to give us his opinions and views on this.
Yeah, it is rightly said. Its entire exercise, the entire approach is based on ABC analysis. If you can regulate 5% of your sector, the entire sector is going to be regulated. So you have to put a more emphasis on top 5% or 10% of the companies, because they have more cascading effect in the financial and capital markets, even the international markets also, as we have witnessed in 2019, what has gone to the ILFS and then the demand. So this is a well thought process, and I am agreeing with this concept, and I am of the view that this is going to reduce the compliance burden on larger number of companies. Because as you said, even the NHB supervisory returns have been segmented into 3 layers. And the companies which are in not even 20 crores or nearing 20 crores or 2 years, 3 years of operation, they have to furnish only few returns. That's all. So second stage and the third stage. So accordingly, yes, entire focus would be on the top 10% of companies. They will be put under this thing. And as you said, we have a 3 layers: base layer, middle layer, and upper layer. And there is, above that is a top layer which is going to be kept vacant. There will be no companies. It is only the RBI and the NHB. We will decide which companies to be brought under the top layer, depending upon the supervisory reviews and the market intelligence and other factors in taking into account. So it is the RBI which will decide the company which is going to be on the top layer. So mainly the companies would be, HFCs would be in the middle and the upper layer only. But all the regulations which is going to come for the base layer would be applicable to the higher scale also. So the base layer companies have been liberalized and the very relaxed way of regulations. But yes, middle and upper layer would be required to furnish. But the basic changes is that on the I'll just summarize. I think Tanya is going to ask questions. It will be repetitive, but at this point, just to keep the flow in place. The basic changes is going to be, which I want to tell, is the exposure norms. Earlier, there were credit and investment exposure. There were separate exposure norms, which is now going to be subsumed. So it will be credit and investment together. It's 25% and the 40% the single party exposure, and the group exposure is 40%. All put together, credit and investment on and off balance sheet exposure, including that also. So that's the basic first change. Then the sensitive sector exposure. So sensitive sector exposure includes the capital market exposure as well as the real estate exposure. So and for the larger companies which are in the upper, RBI has said that it is the board, they have a more different approach depending upon the activities and their exposures. They can have their own, besides the regulatory norms, they can have a lesser, finer tuned exposure norms to the sensitive sectors. Could be capital market, could be real estate, or could be any other. So this is the board which will decide. You have to maintain the regulatory norms, but besides that, within the sectors, the board is to decide the exposure norms for the sensitive sector. The third issue which is going to come is the ICAP, internal capital asset pricing, I mean the capital asset model. So we know we have to maintain certain level of regulatory capital. And for the top layer, upper layer companies, they have to maintain 9% of their capital in terms of their tier 1 capital. It is not the net owned fund, it is the tier 1 capital. In terms of tier 1 capital, you have to maintain 9%. So, and you have to develop your own internal credit assessment model, because taking into view about your different kind of activities, exposures, derivative exposure, whatever be the complexities of the companies, it's the board which will be deciding, and this in-cap is to be, there's a time plan has been provided. So accordingly, you have to come out with the plan. Then the appointment of chief compliance officer. So there's a RBI has said yes, company should have a chief compliance officer. And then the statutory auditor. Appointment of statutory auditor is also, they have said it should be an independent. There has to be a little independence in the appointment of, because there are large groups also. So there are auditors in the other subsidiaries, associate companies, or promoter companies. So that is also to be seen. And the third is the evaluation of the performance of the statutory auditors. So it is the board, after the announcements of the, after the financial results are approved by the board, within 2 months, the board is to evaluate the performance of the statutory auditor. And if there are any disturbing factors or any non-conformities, so it is to be reported to the RBI. So these are the few changes which is thought to be made in the new regulatory framework. So I will open this for Tanya to go step by step.
So the next question we're going to be discussing is the regulatory challenges in meeting the compliance under the new regime. So I would request Mr. Banerjee to share his views with us on this.
I think Sir has already summarized it. So he has made this question infructuous. I would have possibly said the same thing, because capital market exposure and real estate. Because see, if you look at the regulations that have come out already, largely all HFCs, at least the ML and the bigger ones, would be compliant already in some form or the other. Like say, if you take the chief compliance, it's maybe the person who's doing the compliance function will have to align as far as the degree and distance from the CEO's position is concerned. You have to have someone who's only 2 layers down. So that alignment needs to happen. But largely, I think companies would be already in compliance, be it KMPs, be it the board policies, be it corporate governance levels. Core banking, there's some software. At the moment you have 10 branches and all this. There's already some linkage which largely institutions are working on. I don't really see too much of an issue there. I think Sir has very clearly specified that sensitive sectors, I think they've been called as sensitive sectors. So the regulator is in a way very tacitly indicating that this is something I'm going to look into, which is why they've categorized initially as what is a capital market exposure and real estate, and the compliances around each one of them. So that is where I think the scrutiny is going to be absolutely detailed in my understanding. I do not think the rest will be too much of an issue. There'll be more of compliance and good governance and standards of good governance that need to be brought into this sector, similar to the circulars we have seen being issued by RBI to banks. So largely the concept is very similar. It is here that the assessment and the board policies and how each enterprise is dealing in these sectors, what are the thresholds, what are the concentration levels of concentration of credit levels at a particular and which flexibility the circular allows to all the companies, so to say. So that is the thing where I think there will be a very granular assessment and understanding as we move on. I think that's how it's going to play out.
Yeah, I know we have to leave early. So
I'm so sorry about this, but I have a hard stop at 5.
So before you head out, I just have one last question for you. In your view, would the new framework be beneficial to the NBFC, HFCs, and would it lead to any reduction in compliance?
So, Sumesh, what one needs to see is not uh, a smaller perspective of, say, NBFCs and HFCs. We really need to see it in context of the larger economy, in context of how the BFSI sector is going to play out. I think Sir has already taken the name, so I'm taking the benefit of repeating the way ILFS had impacted the entire sector. I think that is what needs to be seen. And in that context, if you put things in perspective, like the NCLAT had dovetailed Companies Act and IBC together. I mean, it's a concoction we have not seen. So that is the impact that one case had on not only the industry, but also the approach of the judiciary. It is unprecedented. If I see it in that context, Sumesh, these compliances in some form or the other already exist. There is some tweaking, some detailing, some granular approach that the regulator is going to have at the company level in terms of which how the companies are operating. That is, I think, the control that the regulator is trying to establish in terms of the circular, which is where it's saying that if you have the ability to impact the economy as such, then I want to see you from a closer perspective. I need to understand you better. As against someone who is a smaller enterprise who doesn't have the ability to impact anyone, is working within a group company, so to say, or just completely isolated in its existence. So that is so I think the regulator is saying, listen, I'm not interested. Please do your disclosures, have your policies. We are fine. And that has already come out in the regulation. But the moment you have the ability to impact and have a cascading effect on the markets, it translates negatively and very poorly. It reflects as a country. It doesn't reflect too well. I think that is the approach. And that, if you see at a holistic level, is good governance. I would not say that this is a compliance. I think it is a good governance which is coming in. That is the theme. The moment I see this regulation, the moment I see the ethos of this regulation, Sumesh. Thank you. And I'll take a leave here. Sorry for this, but I have to get on to something else. I'll take a leave. Thank you, sir. Bye, Sumesh. Bye, Shakil, Satish. Thank you.
Bye, Nanda.
Thank you for being here. So coming back to our question, is the new framework in any way, in your opinion, is it going to benefit the NBFCs in reduction of the compliance burden? I'd request Mr. Khan to give his views and share his views with us on this subject.
Yes, our view is that it is definitely going to help us in reduction of the complexity of compliance, if not the compliance itself, because this is making the whole thing very simple. And I think it started even before this, because I think the first thing which happened is that RBI playing a more active role, because initially NBFCs were ruled by they were governed by how RBI used to operate, and largely the HFC piece was done by the NBFC. I think there is a lot of parity on that, a lot of those compliances, including the master circular getting rolled out by RBI. So I think part of it anyway happened there. So I think that there is a less and less arbitrage as we move on, which is coming in, and I think it will simplify the compliance for the HFCs for sure.
Right. Thank you, sir. I'll request Mr. Nair to give us his opinions on this.
So I just want to add to what Shakil just mentioned. Well, compliance is a fact of life, because that's a regulated environment we live in. But again, I just want to leave a thought with such eminent people on the panel and also in the audience, is that why can't we look at a regime where we are looking for more of disclosures rather than getting regulated? I guess making more disclosures, being transparent and giving that information out is the biggest way you can resolve many of these issues. What happens is in a more regulated environment is that there is a propensity and the incentive to actually go and hide more rather than disclose more. Then the easy way out is that, oh, I need to only disclose how much it has been asked for. Rather than that, go out and put the information out, and put it, let it be there on your website or wherever, like it's in the developed markets or in the other economies, simple things like, the data being filed with the regulators are also hosted on the websites or portals. It is not there. Today the lenders ask for that data or ask for the filings, and with great difficulties the lenders actually get it. So it is a more comprehensive thing. I guess the compliance levels for HFCs are NHS robust, because again, thanks to NHB, the way they have worked and put this things in perspective. RBI just I would say making it and taking it to a next level altogether. I would add that along with the compliances, transparent disclosures would be the right recipe for a prudent capital market and HFCs to perform.
Thank you, sir. I request Mr. Saxena to give us his views on this subject.
Yeah, I share the views what Mr. Satish has said. We should not see the things as a compliance itself. We are moving to a digitized world where even your operations are API based. There are a lot of fintech activities, fintech companies have come in picture and helping the finance companies, NBFCs, banks in augmenting their resources, augmenting their business, and managing their even internal, but it is all API based, and all your information is being shared, in a cloud-based environment. So I will say what he said: openness, transparency, and disclosures. So that's the thing which has been added, which has been, and you have to be transparent and with the customer, with the investor, with the regulator, everywhere. Even the NLP is asking your data. It is not the batch process data. They are asking your business data to be made available to them. I think if you think that from the company they have asked to share the business data, online data. So that's the thing. So we have to work in an open, as if we have to work in an open environment instead of a closed environment. So that's the idea behind, and yes, there is a lot of information which is going into the scrutiny of the auditor also and the RBI also. So, but the things will settle down. It is not something which is thrown and you have to comply in certain date. There will be a good number of period and years will be given, and there is a hand-to-hand support also available from the regulators.
Thank you, sir. I request Mr. Sumesh Devan to give his opinions on this.
Yeah, so we have a quite a esteemed panel here, and a lot of discussions happen on this point. But I would like to share my views and say, in a way, yes, the sector is over-regulated, and but then nevertheless, there is a requirement of an overall and requirement of a new set of regulations. Although there will be some sweeping changes wherein even issues like corporate governance norms and disclosure requirements, and of course a lot of data has to be shared. But seemingly the way housing finance sector and the NBFC sector has been going for the last 2-3 years, and we've seen collapse of some of the larger players, I think it's imperative that the government puts in place a new set of guidelines, and hopefully this will reduce, maybe increase or enhance the compliance levels in the short term, but lead to lesser misery and must be beneficial to the overall sector in the longer run.
Thank you, sir. The next question that we're going to discuss is, what are digital outsourcing guidelines and how are they going to help in enhancing the business of the HFCs or the NBFCs? So I request Mr. Khan to share his views with us on this.
So you want us to repeat the question? Yeah.
Okay, I guess Shakil's video has got frozen.
Sakesh, can you take that question first, or should I repeat the question?
No, I guess I'm happy to take that question. So, should I go on?
Yeah, please.
Yeah. So it's a very interesting thought, and again, if you see how the global scenario has been panning out since the GFC, is that more and more what has happened is that the shadow banking, what we call as NBFCs in India, has started to become more of a originator compared to an asset holder. And what happens is that they become an originator, and the banks or the larger institutions become a warehousing for that. So India is no different. Again, the panacea is that NBFCs would not have a better liability franchise compared to a banks at any given point of time. NBFCs don't have a lender of a last resort like RBI, for where they can actually go and repo when situations like liquidity crisis or something like that could hit. So, Mish, I recollect, my discussions with large NBFC CFOs way back in 2010, 11, 12, when we used to talk about, scenarios like liquidity crisis. The best, they said that what will happen at best, my, cost of borrowing will go up by 100 basis point, 150 basis point.
Right.
When asked about liquidity crisis, they said, no, liquidity is there. No, that never happened.
Absolutely.
2018, you know what happened, right? So the model has completely changed. And I guess the scale-based regulations will only eventually play out at what has been, coming out of this. When you attain a size, eventually NBFCs will have option only to become originators and warehouse their assets into a bank. So I guess digital is the way, because that way you can save a lot of cost. You can reach to a much wider target group, and you can be more efficient in terms of processing the outcomes, whether it be related to processing a loan or giving a customer service or anything. Digital is the way out, and the way the revolution has happened, during the pandemic and now post-pandemic, coming to the connectivity part. This is here to be a mainstay, and you will see many more, I would say, innovations around that.
Thank you, sir. I request Mr. Khan to give sir, may I read the question for you?
Yeah.
Yeah. So the topic we were discussing was, what are the digital outsourcing guidelines, and how is it going to help in enhancing the business of HFCs and the NBFCs?
See, I think one of the key aspects of the the digital outsourcing guidelines is the way the customer's data privacy is going to be handled, the way this data is going to be stored. I think those are two key aspects of those guidelines. And I think internationally there has been various kind of issues around that, and we have seen that impacting India also. I think the digital outsourcing guidelines are giving a clear way out of putting any unnecessary risk on any of the financial institutions to go through similar sort of stress. And as I think Satish said, that it'll only help in defining how the connected world is going to operate. How between NBFCs they are going to operate among each other, and how they are going to operate with the larger the infrastructure of the financial services, be it banks or be it customers. How that data, that the entire data operation, data storage, privacy issues going to get addressed. And I think as we move more and more into these digital guidelines, I think we'll find it much easier to operate without getting into any pitfalls of regulatory or compliance related minefields. So that's why we.
Okay. Thank you, sir. I request Mr. Saxena to give his views on this subject.
Right. As we have said, and we all agree that we are moving towards a digitized world, and many of the companies, it's not the traditional approach of sourcing the customer. It is now the digitized approach. Many companies have their own digital world, digital portal, where they can share the digitized companies, digital portal they can share with a number of NBFCs. They can get into one common portal, and where that digital company will be placing the product and services of the respective NBFCs or banks to the customer. So the regulatory guidelines governing the digital approach is basically towards the fair practice, transparency of the customer. Your product and services should be put at a proper perspective. It should not be misled, and you are the lender should be brought out on the digital company's portal if your services are being put on the digital portal. So it is the name of the company, and similarly on your website you are outsourcing which company, which digital portal. That is also to be brought out on your portal or the website, so that there is a common transparency and the transformation information is available to the rest of the world. So basically, the regulation is mainly focusing on the fair practice side. Your cost, your pricing, everything should be put on proper. It is your responsibility. Liability will remain to you. It is your due diligence which will work. It is not the digital company which is going to. They will be doing their important part. They will be bringing the customer to you, but it is your KYC, it is your pricing, it is your product, and your liability would be there with the company. So basically, it is all based on the fair practice. That's why I understand it's a regulation towards a digital approach.
Thank you, sir. That brings us to the end of this webinar. I'd really like to thank all of our panelists for joining us today. And I'd request you all for your closing remarks. Mr. Nair, I request you for giving closing remarks for this webinar.
Thanks, Tanya. Thanks, Sumesh, to first of all invite on this panel discussion and share our views. Seldom we get to discuss this kind of issues on the open and take views on that. But yeah, I guess my closing remarks and definitely would like to highlight that I would like to see how this entire space now unfolds, and again, we're speculating a bit, but I guess what we've been hearing for the last 5 to 6 years is something which is now getting to a reality. And more interestingly, I would again put the emphasis on more transparent disclosures, put the information out there, let the world decipher, and read out who are the better companies compared to who are not doing it. That's the right way of doing it. And as you always say, market is the karma murmi to test ourselves. That is the panipat for us to fight it out and do it, rather than sitting in the comfort of the offices. So I guess that's where we should be in. Let's see in the market how things are, and let's the best things work out. That's my closing remarks. Thank you.
Thank you, sir. I'd request Mr. Shakil to give his closing remarks.
Yeah, see, my view on this entire thing has been, I think the way this entire compliance framework has been going, I think it has been moving in a very, very positive direction for last couple of years. Especially last 4 or 5 years, it has been moving in a very positive direction. I think things are getting simplified, and I think the one fair thing is that the HFCs especially are getting recognized as one of the nation builders. Because the kind of support we have participated in a lot of government programs like PMAY, the way the HFCs have gone and disbursed money, for the government on the PMAY side. I think the sector is getting recognition in itself to as part of the nation building. And my view is that as we move on and we simplify things, I think we are brought at parity with the other financial institutions. I think it is only going to help the country and the way we are moving, and I'm looking forward to it.
Thank you, sir. I request Mr. Saxena for your closing remarks.
Yeah, I agree with my analyst also. It's a positive way of doing it because things are coming in a bigger way. Interconnectedness is going to increase, transparency and everything. What you are doing in a closed group is known to the rest of the world. It's going to be known to the rest of the world. The things are not remain on your table. So that's why we have to move our operations, we have to move our supervision, we have to move our governance also to that direction. And this is the thing which is going to help the new regulatory framework and the supervisory oversight is going to help us in taking the companies in a business in a larger directions, because it's going to be a global business. You have an investor waiting for you to participate in your business, to participate in the technology, to bring the money, capital, everything. So that's the way. It's the right approach and the right time we are moving. So I appreciate whatever has come to these regulations, and it is things have to unfold. We have to see for another 2-3 years. There will be a hand-holding exercise also from the regulator side. RBI has said they will be issuing the set of guidelines also on various aspects. So we can wait for that. So all the best for everyone.
Thank you. I request Mr. Sumesh Diwan for your closing remarks.
Yeah.
Thanks. Since typically I would be saying, one, thanking all the panelists and all of you for being here and having a great interaction. And vis-a-vis these policies, I think it's quite a welcome change to have a new set of regulations. We're gonna have some challenges in the beginning, but I believe in the long run and making the housing finance sector more robust and digging out the ineffective or smaller players who are not here for, which actually been giving a bad name to the whole sector. The guidelines which are becoming which obviously there will be a lot more coming in terms of corporate governance norms and lot of checks and balances. So I think I will end by saying it's a welcome move and hopefully it will take the sector or take the whole housing finance sector to a much, a greater, it would typically the sector is going to grow much more than where we are right now.
Absolutely. Thank you, sir. I'd like to thank all our panelists for joining us today and sharing your valuable experiences and knowledge with us. I mean, even for me, like when I was listening, this is a really very knowledge enriching experience, because having regulations is one and having a discussion about its pros, cons, its applicability it's very enriching for me as well. So thank you so much, and I'm sure our audience really liked it. Thank you so much.
And anyone have any questions?
If anyone has any questions, the floor is open. Okay, so if there are no questions, we'd like to end this session here. Thank you once again for joining us.
Thanks, Rakesh. Thanks.
Thank you. Thank you, everyone. Bye-bye.
Thanks.
Thank you
Thank
so
you very
much.
much.